Welcome to the Live Big podcast, where real estate expert Nick Paynes shows you that everyone can build wealth through real estate investing. Nick and his featured guests will give you the tools, resources, and expert information you need to leverage real estate into a wealth-building strategy, so you can stop worrying about your 9-to-5 and start to live big. Here's Nick with today's episode.
Hey everyone, Nick Paynes here from the Live Big podcast, episode 2. Going to be a great episode today. We're going to talk about some of the metrics and really some of the acronyms that we use in real estate, especially in real estate investing, talking about the types of returns that we're expecting, the types of returns that we're looking for on some investments. So we use a lot of acronyms in this business. We'll use a lot in this podcast. So it's important, even imperative that you understand not only the acronyms, but then understand the concepts behind them. So we're going to talk about those a lot today. That way, when you get into the industry, you're looking for your first deal, you're making your first deal, you can have the commercial, well, not just commercial, but you can have the residential and commercial real estate lingo that you need to sound like you belong there. So anyway, let's get started. First thing that we'll talk about is ROI. It's one of the most important ones. It's return on investment. And it's a total metric for return. So usually it's going to encompass all forms of return, especially if the asset class has more than one form of return. So for example, in stocks, you have the ROI of the stock increasing in value itself. You have the ROI of potential stock splits. You have the ROI of dividends that are given out, maybe dividends reinvested. So it's your total thing. On the investment real estate side, generally we're talking about generally 3 forms of return, but I think you could venture to say that there's a 4th. So the 3 forms of return in a real estate investment are going to be your cash on cash, which is another acronym. When you see it in writing, it's capital C, lowercase o, capital C. So that's your cash on cash return. That is the cash that you make once you have paid all of your expenses on a monthly or yearly basis. So that's return number 1, is your cash on cash. Your second one is your principal pay down. Obviously, when you buy a piece of real estate and you leverage it using a mortgage, anytime a payment is made towards that mortgage, anytime the tenant pays rent and you make a mortgage payment, it decreases the amount of principal that you owe and adds to the total value of the investment. So principal pay down is number 2. Your third type of return is your appreciation of the asset. So obviously, again, with stocks, that's the amount of the stock increases in value. Same thing with real estate. So if a $400,000 property appreciates to $500,000, you have $100,000 in appreciation, and that is going to be a metric that we use in the return based on your original investment. So that 4th one that we talked about is kind of something that a lot of people don't think about, but it's your tax savings. So real estate, as we'll talk about in some other episodes, are a great tax shelter, a great way to decrease your tax liability and really ultimately increase your total ROI. So those are kind of the 4 main types of ROI that we talk about in investment real estate. So next metric that we talk about, with a couple different ones that people tend to conflate. They seem like they're the same. They sound like they're the same, but they're really not. So those are internal rate of return, average annual return, and compound annual growth. All 3 of these can seem like they mean the same thing, but they don't. So the first one, internal rate of return, is a more complicated metric. It's a calculation that takes into consideration net present value and future value of money. So I'm not going to get into this one. It's a big calculation, and it's something that we use to really try to understand the future value of an investment. And so it's kind of a rabbit hole to go down that calculation. So we're not going to talk about that one today. We may cover that one in a later episode. The next one is an average annual return. The average annual return is a good metric But the problem is that if you have any negative returns over a period of time, your total return can be skewed. So, for example, if you have let's say you have a stock for 3 years and it goes up 5%, 10%, and 6%, your average annual return is 5 plus 10 plus 6, which is 21, divided by however many years you held the asset, so 3 years. So you're going to have an average annual return of 7%. Okay. The problem is when we have negative returns. So, for example, if you have a $100,000 investment, okay, and you lose 50% in the first year, okay, you're going to have $50,000. And in the second year, you gain 50%, okay, you're going to gain $25,000 and your investment is now worth $75,000 or a 25% loss. But if you use average annual return to calculate it, your average annual return is positive 50% plus negative 50% is 0, divided by 2 is 0. Okay, so the problem is you'd have an average annual return of 0, but you would have had an actual negative return. So that's the problem with using average annual return. So the one we tend to use most, especially on a look back of how we returned on a particular asset, is CAGR, is compound annual growth rate. Compound annual growth rate takes the beginning and ending value of an asset and it calculates the average annual return that way. So this is the one we prefer when calculating. And it's not an easy by the book calculation. It's something you can put into Excel. There's compound annual growth calculators online that you can use. But that's the metric that we like to use when we're looking back on an asset. If we've held it for 5 years and we sell it, we can take all the profit, put it up against our original investment and come up with a compound annual growth rate. So that's the one I think that's most important to use when we're talking about return metrics on a yearly standpoint. Okay. All right. Our next one is the next one that we'll talk about is cap rate. So your cap rate is something that you hear a lot in investment real estate, and especially once you get to bigger units and commercial units, it's almost exclusively the metric that we hear to understand the value of a property or to understand its return. And a cap rate is really pretty simple. It's your net operating income divided by your purchase price. Okay. So if you've got a property that's selling for $1 million and its net operating income is $100,000, you're going to divide that and you're going to come up with a 10 cap rate. It's 10% basically. Okay. And what that means is it's going to take you 10 years to recoup the purchase price of $1 million with the $100,000 of net operating income. Okay. So the thing about cap rate is it takes into effect net operating income generally before debt service. So the calculation is based on purchasing the property cash. Now, what we talk a lot about in this particular podcast is the power of leverage and using leverage to buy property. So with most of the stuff that we look at, cap rate is a good baseline or a good guideline, but it doesn't properly indicate the actual return of the property. So when we use cap rate, it's really just an understanding of how expensive the property is. And that is probably the baseline that we go on when we're looking at, for example, a piece of commercial real estate. We know that, for example, in the Denver metro area, a multi-unit apartment building, that the standard cap rate in Denver might be 5.5. So if we see a property that's listed at a 3% cap rate, it means it's way too expensive. It means that the sellers are asking way too much for the property. If we see a property that's selling for a 7% cap rate, it's either A, a really good deal, or B, something's majorly wrong with it because it's heavily on sale. Okay. So there's some other episodes where we'll talk a little bit more about cap rate. We'll talk about cap rate compression and what happens when people basically force the market into a particular cap rate. So we'll talk a little bit more on that. But again, cap rate is a metric that compares the price of the property buying the property in cash to its amount of return. It doesn't really take into consideration debt service. So the next one to look at is what we call an equity multiple. So an equity multiple is a metric that measures the total cash return over the entire lifespan of an investment. So it doesn't matter how many years it takes. Your equity multiple is, for example, if you invested $100,000 and you got $150,000 back, your equity multiple is 1.5. So the problem that I see with equity multiple is that it doesn't take into account that time frame. So if you ask, oh, well, is 1.5 a good equity multiple? Well, it depends. It is if you're holding the asset for 1 year, but if you're holding it for 20 years, no, that's a terrible return. So it's the same equity multiple, but in one case it's really good, in the other case it's bad. So equity multiple again is in my opinion kind of a very rudimentary metric that doesn't give me a whole lot of information, at least. So next one, let's talk about net operating income, just because we've already used it to calculate another metric. So your net operating income is pretty simple. It's your NOI, and we use that acronym a lot. So just remember, NOI is net operating income, and net operating income is your gross operating income minus your expenses. Okay, so if you have a small apartment complex and you get $200,000 per year in rents, and it costs you $80,000 a year for gas and electric and all the other stuff, then you have a net operating income of $120,000. This does not include your debt service. So again, if the property has a debt service involved with it, leverage, a loan, a mortgage, that is not going to be included in your net operating income calculation. That will come after the fact. Okay. So cash flow. Cash flow now takes into consideration having leverage. So your cash flow is the amount of cash you have left over after paying all of your expenses, including your debt service. So if we take that same building where we're making $200,000 in rent, and we have $80,000 in expenses, and then let's say we have $100,000 in debt service per year, we're left over with $20,000 in net profit at the end of the year. So our cash on cash is $20,000 per year, or around, what is that, $1,700 per month. Okay, so that is your cash flow. Your next is your loan to value. So loan to value is your LTV, another acronym you'll hear a lot. LTV, loan to value, has to do with the leverage that you get. So most banks on residential properties as investments will loan you anywhere from 75 to 80% loan to value. It means they'll loan you on a $500,000 home, they'll loan you $400,000. They'll loan you 80% of what the property is worth. As we go into the commercial world, we tend to see that number increase a little bit more, or the loan to value decrease. So 70% loan to value, 65% loan to value. And you'll see it in the smaller world when you go to buy maybe your first property, you might be able to get a 95% or a 97% loan to value on an owner occupied property. So LTV is something that you'll hear us talk about a lot, an acronym that you'll see a lot. Okay. Next one is debt to income. So your debt to income ratio is how much debt you have versus how much income you have. This is a qualifying factor that you're going to have with your mortgage originator. They're going to figure out how much your expenses are on a daily basis or on a monthly basis, and compare that to your monthly income. Okay, that's how you qualify for a loan. So that is your debt to income, or your DTI. Okay. All right. Moving into one more loan type, or actually two more. Let's do two more that we're talking about with investment real estate as far as long-term rentals and returns are concerned. Your next one is your expense ratio. So your expense ratio, we use that mostly in larger commercial real estate. And it's basically, what is the ratio of expenses versus your total income that comes in? So again, going back to that property that's bringing in $200,000 per year, 80,000 of it is going to expenses. Okay, we have a 40% expense ratio there. Okay, We have that expense ratio number because as we go into different markets, especially in commercial real estate, we're going to have different standards of expense ratios. And that's what helps us determine whether or not we're purchasing a property in that market. So for example, if Denver has on average for large apartments or residential, real estate, if they have an expense ratio standard of somewhere around 35%, and you see a commercial property that you'd like to buy, and when you see their trailing 12 or you see their books, their expense ratios are at 50%, you know that there's room for improvement there, which is going to increase net operating income, which is then going to increase the value of the property. So again, we'll talk more about that in a different episode, but expense ratios are really important because they're generally standardized in certain markets. So Denver might be 35%. You might go to a high property tax state, for example, let's say Illinois, go into the Chicago area, really high taxes, same thing with New York. Those expense ratios might be significantly higher. Okay. So if you've got high taxes, if you've got high insurance rates, your expense ratios are going to be significantly higher. And you need to know that about that potential local market. Okay. So again, you come into Denver with a 35% expense ratio. There's two things you're going to learn from a trailing 12 or from a profit and loss statement. You're either going to learn that there's room for improvement, right? And you can bring a 50% expense ratio down to 35. Or if they show their expense ratio at say 20%, something's wrong. They're not tracking things properly because there's no way you're running a multi-unit property efficiently with a 20% expense ratio. Funds are being misallocated somewhere. There's something that is falling off the book somewhere that you need to find during your due diligence period. So anyway, that's a little bit more about your your expense ratios. So the next piece I want to talk about is just a few more acronyms, and really this goes into a different portion of investment real estate, and this is in flipping. Probably the most important thing that you'd like to have or the most important thing with flipping property is understanding your ARV value. So another acronym, ARV, after repair value. So when you're flipping a property, this is the potential value after all repairs or renovations have been completed. Okay. So it's really difficult to evaluate a property that's in disrepair because there's very few comps for it. And it's just it's hard to understand the value of a property that needs a bunch of stuff done to it. So what we do is we actually figure out, okay, if this property were in perfect condition, what would it sell for? That's easier to comp. There's going to be more like properties in the area that we can take. So we take that after repair value, and then what we do is we start subtracting the cost to repair, renovate, resell, holding costs. We start taking that money off of the after repair value, and then that will come up with a purchase price. So if you're a flipper and you've got a particular margin, or you want to be a flipper and you've got a particular margin you want to hit, or even a particular flat rate, like you want to make $20,000 on every property, fine. Take your ARV, your after repair value. If it's $500,000, take your real estate fees off of that $500,000, then take your repair and renovation fees off of that, and then take your holding costs off of that. So the cost of your money, the cost of taxes while you're holding the property. So you're going to take all of that off. And then the last thing you're going to take off is that $20,000 that you want to make, and whatever number you come up with, that should be your offer price. Okay. So after repair value is incredibly important when we're talking about flipping property. And we do the same thing on bigger units and on multi-units. The difference is we're looking more for not getting it in line with the neighborhood properties. We're looking at ways to increase net operating income. So when we increase net operating income, we increase the value of the property. So that's how it works a little bit more on the commercial side. So let's see. Let me make sure I didn't miss anything here. Let's see on the flip side. Oh, last one I wanted to talk about. This one again is important for the commercial, usually the commercial real estate side, for big apartment buildings. But it can also be done. This is available on the small residential side as well. And the acronym is DSCR. What that stands for is a debt service coverage ratio. And the reason it works on both sides is that there are things that are called debt service coverage ratio loans that you can get in order to buy investment real estate. So even on the single family side, you can get if you want to buy a single family real estate rental property, you can get a debt service coverage ratio loan. And what that does is it takes out of the equation your personal credit score, your income, your debt, and it only looks at the property. So it looks at the property and it says, can this property make enough money to cover the debt service? And it's usually some sort of multiple. So like might be 1.2 or 1.5. So if the debt service is $2,000 per month, a multiple of 1.5 would mean that the property has to rent for $3,000 a month in order for them to give the loan. Okay. So that's what a debt service coverage ratio loan is. When you're on the commercial side, pretty much all loans are debt service coverage ratio. So you have to qualify using debt service coverage ratio, especially when you're buying bigger properties. So if you're buying bigger multi-unit properties, it's really important that the bank has an asset that can cover the mortgage, because most individuals or most people that are buying bigger units and most units, let's say it's a 100-unit apartment building, most of those aren't purchased by a single individual. They're capital groups of fundraisers. They're people, it's basically syndication, people putting together large groups of people that bring money into the deal and own small portions of that apartment building. Those loans that are written on those apartment buildings are called non-recourse loans. And what non-recourse means is that those loans, if you default on the loan, if I'm the one that signs on the loan and I default on it, I'm not personally liable for that loan. The only recourse that the bank has is to foreclose and take the property. Okay. Well, because banks are not in the business of owning property, they don't want to own property. They need to make sure that in the event that they have to take the property, that there's a significant amount of money that's coming in, that their risk is worth it. Right. So generally speaking, on commercial side, especially apartment buildings, the debt service coverage ratios that banks are looking for are somewhere between 1.2 and 1.3. So again, if you've got if your debt service is $100,000 per year on an apartment building, you've got to have at least $120,000 to $130,000 in net operating income before they're willing to write that loan. So again, non-recourse loans, they're going to have debt service coverage ratios in them in order to qualify. That doesn't happen on single family stuff unless you're getting a debt service coverage ratio loan. Those loans on individual, like single family properties, are usually significantly more expensive than government backed loans. So they're kind of like last case or worst case scenario. If you really wanted to buy a rental property, but didn't have the credit, didn't have the income, the debt to income ratios that you need to qualify, you could potentially do a debt service coverage ratio loan, but it will cost you. So anyway, let's see if I've got anything else here. I don't think so. Great episode today. I know there's a lot of info here, but if you're wanting to learn more, just remember you can always go online, check us out, Meta Homes Team, Black Yeti Group. We have websites, we have socials, they're all in the description. And don't forget to subscribe so you don't miss our next episodes. Remember, next episode coming next Wednesday. Make sure hit the like button, leave us a comment. If you have any questions, leave us a question. We might even answer your questions in a later episode. And make sure that you catch me next week. We have a very special guest, Jamel, coming on. She's one of the top producing real estate agents in the nation. And I'm ecstatic to have her join me to talk a little bit about setting goals, creating systems for success. So great episode. Pleasure having you with me today. Thanks for tuning in. And remember, always live big.
Thanks for joining us for this episode of the Live Big podcast. For even more real estate and investment resources, go to blackyetigroup.com/resources and download Nick's complete guide to running your own rental properties. Tune back in next week for another episode, and until then, live big.
Live Big does not provide investment, legal, or tax advice, and nothing herein should be construed as being financial, legal, tax, or other advice. Live Big does not represent that any securities or services discussed are suitable for any investor. No investment or other decision should be made solely based on the contents or information found on the website or podcast. When making a decision about your investments, you should seek the advice of a professional financial advisor or qualified expert.